So it's been a great day. I would say we were a little exhausted until some Cuban rocket fuel there. So if I speak a little quicker than normal, I apologize. That was Francisco loading up on coffee. But anyways, thank you all for being here today. We've had a long day of panels and just great content. I sure hope the club, we're going to put this all and digitize it to be able to process it again. But we get to talk about private market opportunities, which could be on the equity side, the debt side. To me, being a private equity side and also having a credit funds, it's an extremely exciting time to be investing. There's a lot of opportunity out there. There's a lot of uncertainty. We're trying to figure things out, so hopefully our panelists here could help us. So I want to start with the big question for everyone. I'm going to start with Mauricio. I wanted to talk about the current state of the investor. How are the current fundraising cycle going? And what are you seeing out there on the global deal-making front?
Well, thank you so much, and thank you for the invitation. Congratulations on the Miami Economic Club. And let me recognize in the crowd the greatest congresswoman that South Florida has ever had, Ileana Ross-Lehtinen, former chairwoman of the House Foreign Affairs Committee. So it's an interesting environment. I've just come off some roadshows in the Middle East and in Asia, and there's a ton of capital out there, and there's a few deals. And so, people are looking, well, what to do with capital. And then you have the interest rate environment here. And with the interest rate environment here as well, it's kind of become a bit of a cyclical flow. So if you're, BlackRock, Blackstone, KKR, the big ones, great, it's awesome, right? Because at the end of the day, there's capital pumping out, particularly in the Middle East, that needs a place to go, and they don't like to take risk, and they like to take big checks. And so at the end of the day, you're seeing fund after fund, et cetera. Now the pressure is creating for these big institutionals to deliver, right? They need deals. They need to deliver in that regards. So overall, if you're a smaller fund, it's a tough environment in the fundraising side. Why? Because at the end of the day, there's interest rates are high. There's different alternatives out there, and people say, hey. In my case, I'm an emerging markets fund. Obviously, we focus in on Latin America and the Caribbean and the high growth markets, and we have really attractive returns. But yet others saying, hey, look, you can get pretty good returns here with no risk whatsoever. So why not just, sit on some vehicle here that at the end of the day won't shake things up too much. So, it's become a little bit, unfortunately, a big circular flow in that regards. And I think that's bad from the development side, particularly if you're like an infrastructure fund like ours, because you want to see things get done, and there are a ton of deals out there. We see a ton of deals in Latin America and the Caribbean, and unfortunately, it's kind of fallen in the wayside. Now, if you have projects here in the U.S., yeah, they want. That's a great opportunity, but otherwise, it becomes a little bit more difficult.
Dom, you want to jump on that one?
Sure. First off, thank you for having us, and appreciate you all being here. I wish my home state of California was as business friendly as you guys are here in Florida, so kudos to you all. We're seeing plenty of interesting opportunities in the US and in Europe. We're sitting on approximately $1.9 trillion in dry powder amongst private equity, an all-time high. Yet you're seeing the pace of deployment in the back half of 22 and most of 23 was relatively subdued. And certainly when it comes to monetization or exits of private equity portfolio companies, approximately 75% lower last year versus 2021, when it was at an all-time high of roughly 800 billion. I think last year it was roughly 43 billion or so. And the main reason for that is because certainly interest rate risks, and also in terms of deployment, a lot of private equity investors were hesitant last year to put that capital work because everyone was quite worried about the macroeconomic conditions. Whether the US is heading to a recession or not, we could discuss that certainly later. Things seem to have changed, certainly even the past 3 months versus, say, October or November last year. I think the overall sentiment, speaking with a lot of our private equity clients, are much more bullish today due to a number of factors. And with all the dry powder sitting out there, 24 is likely turning out to be a very good year.
Awesome. Christian, you invest in, you work with the family office. Maybe you could talk a little bit about that, but you guys look at all types of different deals. What are you guys seeing out there? What's exciting for you?
Sure. Nice to meet you all. Thanks for having me. I'm a new Florida resident after leaving California for many of the reasons Dominic referenced. But yeah, as a family office, I think Jeb and I were joking around about this on Wednesday. Once you know one family office, you know one family office. Essentially, a lot of the investment strategies, liquidity needs, and just prospects for where they want to deploy capital vary domestically, abroad, what have you. I work for a family that is based in Michigan but has substantial roots in South Florida. The Taubmans built the Dolphin Mall here as an example. But big picture, I think where I focus, which is in lower middle market and middle market private equity, a lot of the observations would echo what Dominic and Jeb mentioned. But to be frank, we don't really invest on a macro basis. We really look at company fundamentals, opportunities that are specific to that business. I think valuations and liquidity certainly have been impacted by the change from the zero rate environment to the current rate environment. But I think for us, we kind of, not to sound too boring, but we just stick to what we know. And I think we certainly have seen a pullback in the desire for exits on behalf of sellers, whether those are family owners or institutions like private equity, because I think folks just think that valuations aren't going to be fully maximized in this environment. But at the same time, there are catalysts for change. You still have ownership transitions driven by families wanting to, affect succession planning, or, folks just wanting an exit. So I would say the environment's been very active for us. I'd say at my January 2020 inbound deal flow, which is sort of the top of my funnel, was up 20% over last year. But last year wasn't a particularly bad year either. So net, we're active. I think anytime where you see unemployment kind of currently where it is, as well as a myriad of other kind of factors in the U.S., we're conservative. We just think that it's likely that things will get more challenging before they get better. But uncertainty breeds opportunity for us.
Christian, you said two words as a private equity guy that are great: liquidity and exits. I picked up on. And just kind of pull that thread a little bit. Maybe, Dom, we could start with you here. Wanted to get your thoughts on the M&A activity in IPO market. IPO market has been totally flat, probably the last 12 months, and now starting to pick up a little bit. Where do you see that going? How do you see M&A going?
Sure. The IPO market has, as Jeb alluded to, has been relatively dry. It's down roughly 90%. Yet we're sitting on, there's roughly 650 unicorns around the world that have not gone public yet. Last year, we saw ARM Holdings and Instacart go public in the September timeframe. That was really kind of one catalyst for the IPO market. And then the unfortunate crisis in the Middle East hit in October, which really kind of put a pause on the IPO markets and the public markets in general. We've seen, however, a little bit of improvement in the public markets, largely because macroeconomic conditions have been much stronger in the US, much more so than in Europe or other parts of the world. So you're seeing a couple companies getting teed up, speaking with a couple large sponsor clients of ours. They have a pretty good pipeline for 2024. However, exit opportunities, oftentimes going public may not be the best option for the company. You're seeing a lot of take privates. Folks like Thoma Bravo have been very active in that. You're also seeing lots of sponsor to sponsor deals, so 50-50 type transactions between large private equity firms. And also, in certain cases, a lot of roll-up companies, larger platforms that are backed by private equities are being extremely acquisitive and rolling up smaller companies. One of our clients, PDI Technologies, which is a ERP platform for convenience store retailers in the US, they've acquired roughly 14 plus companies over the past couple of years, backed by TA and Insight, have been really active in that space. So you're seeing multiple lanes of exit opportunities for private companies, which is very constructive for the overall ecosystem.
Mauricio, thoughts on that?
So on Latin America and the Caribbean is obviously different, which is where I'm focused on and kind of where I want to kind of take the thread. In the same way that as like the fundraising is kind of lazy and it's become lazy because the big sovereign funds, et cetera, just want to write the big tickets to the big institutionals. The flip side happens in Latin America and the Caribbean. The institutional, they want to write the big tickets, and then what happens there just mostly focuses on Mexico and Brazil. When you look at any institutional investments in Latin America and the Caribbean, it's usually Mexico and Brazil, which then tends to be where most of the risk, because of currency and other issues have taken place, and just about anybody that's invested in those, including Argentina as well, I'd add, is also a big country, has gotten burned. So there's no one that's ever not gotten burned in that regards. But what happens there is had a trickle-down effect. And the trickle-down effect is that where the greatest opportunities in Latin America and the Caribbean lie are in the smaller countries. So we've created, like our private equity fund, Lara Fund, we're focused on the small, medium countries in the region. So we call them the Lara 12. These are 3 zero currency risk countries, because there's 3 dollarized countries. So you have Panama, El Salvador, and Ecuador. You have 3 pegged countries. So you have Bahamas, Barbados, and Uruguay. You have the greatest energy stories in the world today, So you have Guyana, which just became the largest per capita producer of oil and gas in the entire world after Kuwait, is basically where you have Exxon that has invested in uplifting 50 to $70 billion, but yet there's no surrounding infrastructure in the midstream, ports, roads, you name it, expat housing, you name it. I mean, it's literally the Wild West. It's like the only country in the world today, we'll see in the Americas, in our lifetime, that has the opportunity to go from developing to developed. You have Suriname that's just 5-10 years behind it. You already have Total committed with $10-20 billion for their upstream. And then you have from the flip side, you have countries like Paraguay with tremendous opportunities, but it's the complete opposite. It's 100% hydro on the energy side and needs to diversify energy away. And then Uruguay, obviously very stable in that regards. And the exits are extraordinary. You know, if you have a functional real asset in the energy space in the region, you will sell it off. You know, our partners at Hudson, we just unloaded the largest solar portfolio in Uruguay, had 18 bids. Like literally people were fighting over it. We unloaded it to a Canadian fund with a 24% IRR. I mean, that's a great opportunity there. And by the way, have a functional asset that's moving, that's producing energy, that's helping people. I mean, it's extraordinary with extraordinary impact in that regards. So what we're doing, what we're seeing is really an extraordinarily unique opportunity in these countries. I'd add the last quarter, there are the 3 OECD countries. I start with Costa Rica. But then, you know, watch Colombia and Chile. Those are 2 countries that their political cycles are turning. It's a great opportunity. The devaluation has taken place. It's pretty much bottomed out. You have, you know, distressed assets galore. Prices are excellent, and you're going to have a huge value increase in a couple of years because these are central-right countries with very strong institutions, et cetera. So the unfair mark that people have gotten because of the currency risk, rightfully so, in Brazil and Mexico, you know, has kind of stained the rest of these countries in the region, which is actually where the biggest opportunity. These are the most undercapitalized, highest growth emergings in the world today. Great opportunity.
That's awesome. Mauricio, you got to call us up for some deals, man. That sounds pretty good.
Yeah, tell me when. I think I have. No.
No, but super interesting. You know, you talked a lot about it, kind of just a lot of macro issues. Wanted to open up to the panel in terms of just, you know, the state of the economy, right? Like the U.S. has gone through this, what everyone was saying for 12 months, that we're going into a recession, political year, huge uncertainty. It hasn't been the case. Global markets have kind of, you know, been flat. You know, how does the economy affect y'all's business?
Well, my business partner worked for a gentleman who I think has a lot of great wisdom. His name is Howard Marks. He's written a lot of memos and has a lot of, he's very good at observing market cycles. And I think my view is when everyone thinks we're not going to be in a recession, I probably take the opposite. So I don't think we're out of the woods yet. I don't think that interest rates are coming down anytime soon. I largely view that there are some political pushings that are influencing people to think that that's going to be the case. I think if you look at the state of the consumer, we have a portfolio of over 40 companies that we have controlling and minority positions in. If you look at the state of the consumer, I do think that a lot of the COVID-related spending and, you know, nuances that change behavior have started to burn off. I do think a lot of folks have more debt than they probably should. And I think that at the end of the day, I think we're in a lower growth environment. I don't think the current administration is particularly business friendly, and between the regulatory changes and, you know, folks like Lena Khan who don't make exits easy for tech companies north of $1 billion, I think I'm generally not particularly excited. I think we're sticking to our knitting in terms of businesses. Historically, we've really anchored ourselves towards high quality businesses that have great recession resistant characteristics, but unfortunately that's hard against the backdrop of a lot of capital. So I also think, you know, going back to the comments made about unicorns, I think there were a lot of bad businesses created and raised rounds at dollar amounts that didn't make sense during the zero interest rate environment. There was a lot of capital chasing ideas and companies presented as technology businesses that were far from it. So I think we have more room to go down before we go up.
Sure. I might counter that slightly, although while the Fed certainly isn't raising rates in March, apparently, the underlying or the underpinnings of the U.S. economy seem relatively fundamentally sound. You look at, you know, labor numbers, GDP growth, inflation coming down, on target to kind of seems like the Fed's path, would eventually lead to rate cuts, perhaps in June or around that time period. But you look at the state of the U.S. consumer, which is roughly 70% of the overall economy, it's surprisingly strong. areas like travel, hospitality, discretionary spending, still extremely robust post the COVID stimulus, and for some reason still continues to outperform many areas. You're hearing a lot of, I think Blackstone was out saying that they're looking within their larger portfolio, and there's definitely a lot of improving inflationary underpinnings, for their portfolio companies as well. And so that's all good for the economy. And then you look at sentiment amongst CEOs. I think Ernst & Young had a recent study in December of last year. 52% of CEOs among Fortune 500 executives are looking to do an acquisition, major strategic acquisition, sometime this year. That's a lot different than 23 and certainly the second half of 22, when there were hardly any strategic activity, large strategic activity on the M&A front, and that's incredibly supportive for the overall macro picture.
All right. Mauricio?
I mean, I don't have much to add on the kind of U.S. macro side. I agree with what they've said. I run a real assets fund, so I don't really chase unicorns. I like horses that run. Interest rates suck. I think none of that's going to change until we see. I mean, it's election year, so that's going to have a different. So I think what I've seen, and hopefully what others see, and kind of when we've talked to investors and others, is just spotting opportunities, right? Just spotting opportunities, kind of unique opportunities per se, and kind of looking at them at a micro level instead of a macro level.
So all of you guys have mentioned kind of interest rates and just the difficulty that there is, right? Lending has tightened up. Fed's trying to get things under control. There's been this kind of huge private credit rush. At least that's what I'm seeing in the market, where people are looking at opportunities to lend. Are you guys seeing that a lot? And do you guys see a bubble come in the credit world?
Yeah, I mean, I think I used to work for an alternate lender from 2014 to 2018. I think whether it was regulatory changes that came about after the GFC all the way through to current environment, I think there was definitely a risk profile that consumer lending institutions should be tied to, and there are other lending activities that should have a different investor base. I'm of the view that it's sort of the private credit's time to shine. I think a lot of folks, a lot of banks, if you just use conventional credit metrics, like with the current interest rates, you can't really get north of 3.5 times cash flow leverage on anything, just because you're going to FCCR out, and banks just won't really budge there. So I think more creative lending strategies certainly are having their moment. I do think that, again, depending on what your objectives are as an investor or an allocator, making 9 to 18%, depending on the profile of the credit product, I think is very attractive in this environment. But personally, I'm an equity investor. That's what I do. That's where I want to be. But I do think it's their time. A lot of banks that we've worked with historically continue to grapple with different sentiment around the changing regulatory landscape, the macro environment. So they're just submitting bids that aren't competitive, and as an investor, I'll take the higher rate and the flexible capital instead of hoping that my bank gets there in a deal.
We're also seeing a little more activity in terms of larger leverage buyout deals, and to Christian's point, more flexibility in capital. Private credit is, to Jeb's point, really exploded over time. $1.5 trillion amongst private credit funds alone. I think it's going to hit $2.8 trillion or something by 2028. But it's many different styles of that, and really proving to be a great alternative to traditional bank lending, particularly in terms of private deals. It's definitely been we're very bullish in that space.
All right, cool. So I'm going to throw a little bit of a curveball at you because Dom told me to. But the kind of the deal-making environment that you guys are doing, you're investing all over the world. Where do you guys see AI having a place in this?
I can speak to this.
Oh,
we
right.
just hired a bunch of AI engineers. We're of the opinion, I think there are two sides to what AI can do, particularly in our part of the market, which I would characterize as 50 to 500 person companies. So this is the predominance of entrepreneurs in the US, sub 500 person businesses. I think we do not see it as a computer's going to take your job. That's not how we're thinking about AI implementations, and we're in the middle of two right now. We largely see it as ways to be more effective, particularly on the outbound side. So, for example, if you have an effective salesperson who can generate X number of leads, which creates this much sales pipeline, which leads to this conversion rate. We just have seen through our own businesses and with others that you can do more targeted, more thoughtful, more automated sales outbound, which again can be very lucrative because theoretically you don't have to add as much to the bottom line along the way. So we are very bullish on where AI can impact what I'd characterize as like the classic middle market U.S. business. And look, on the expense side, sure, there are certain workflows that are very labor intensive that we think can be automated or done very accurately. Like one of my portfolio companies I spent a ton of time with has a very manual process that you all would understand because I just can't give it away. And we got it to 99% accuracy in 3 weeks. So I think the pace of change within the world of AI is going to be very wild for people over time. Like what we're doing today will probably seem, archaic by the time we all talk about AI in 3 years. But the pace of change is wild. I think anyone who's investing in AI companies, I think that's very hard to do because I just don't know who the winners are going to be, and so much of it is open source. So we'll see. I think there are a lot of applications. I wouldn't invest in the companies. I'd invest in the people who know how to implement it.
So let me AI is what it is, right? And you have debate. It's going to create better productivity, efficiency. Yes, all great. There's all the dangers. We're going to debate this a long time. It's a sexy topic. We can talk about it forever, but that's all it is. It's like a sexy topic. I'm going to take this opportunity to actually say what I think is actually a greater opportunity in AI in 2024 and what we should be focused on, and I know it's not as sexy, but it's infrastructure. Like this 2024 is the year of infrastructure. You're already seeing it. The deals are there, the opportunities are there, the tax credits and incentives are there. IRA ain't going anywhere. It's here to stay. It requires 60 votes in Congress. Even if Congress flips, the Senate flips, it's not going anywhere. And at the end of the day, what you're seeing consolidation-wise, you just saw BlackRock, $12.5 billion acquisition of General Infrastructure Partners. You saw General Atlantic acquire Actis. Everybody's looking for infrastructure deals. At the end of the day, nothing functions without infrastructure. Is what you need for growth. And at the end of the day, I think 2024, as I think correctly some of these big institutions have said, and therefore are desperately acquiring infra funds throughout, is going to be the year of infrastructure. The headlines are going to be about AI, but at the end of the day, what moves, gets things going, and what really are going to where the rubber's going to hit the road is on infra.
Definitely. No, certainly adding to what Mauricio and Christian just said, you look at areas like supply chain, real estate, prop tech, things that used to be very archaic, like mortgage applications, very manual, paper-driven process. You're seeing AI innovate a lot of that. Even in our own industry, in deal making / sourcing, there's a software called SourceScrub. They developed a Chat GPT equivalent where you could talk to the computer and it tells you what to look for, competitors. It's really fascinating. I think that's certainly going to change the way we live, work, and play.
Yeah, just anecdotally, we were chatting before this panel. We were talking about traffic, going back to the infrastructure side. Mauricio, would you include digital infrastructure as well?
100%. When we look at infrastructure, we look at it from the energy side, digital side, across the board. I think it is the year of infrastructure. We see it here. We need it for growth. Look at Miami. Miami is the infrastructure story. Like Miami, the infrastructure can't keep up with the population growth in Miami. For those that have been here, forever, all of us that, I'm a Miamian, we're Miamians, you've seen it. That's the biggest need, and it just can't catch up. Now with our fund, and we're seeing countries where that growth is, we're seeing the same thing, which we're seeing those opportunities, Dominican Republic, Costa Rica, Panama to a degree, obviously then Guyana, and others. But that is the big story, in my view, in 2024.
Even with the population challenges, we still welcome Californians. So Dom, anytime you guys are ready, we're ready.
That's why we need more infrastructure. We got to make room for them all.
It's a win-win situation, right? No income tax.
To be here.
Yeah, exactly. All right, well, with that, I think we have about 5 minutes to maybe take some Q&A if you like. John? Any questions out there for our distinguished panel here? Yes, sir?
I'll just speak up. Thank you, panelists, for your comments. So my question, I've obviously heard the I've seen the huge growth in private credit funds. And I think the key is perhaps to looking at the niche funds. But I do have some concerns with so much credit coming to the market. Wall Street's very good at fattening up the pig until it explodes, and then they do it again and again and again. So I'm a little counter-intuitive about that. Are we getting to the point where we've seen the best deals? Is it going to be a fallout, even though there seems to be some good tailwinds? But I do get concerned when everyone on the street wants to do this, and they're just putting larger and larger funds into the market.
Can I add something to that? Because I didn't mention anything before when you were talking about private credit. I mean, look, I like Christian. I like equity. Obviously, because I think also there's, you have the management perspective of it, which at the end of the day is huge in that regards. I just mentioned the project we just exited from Hudson in Uruguay. I mean, literally it was a distressed asset. You took it over, and it wasn't brain science. You just needed it to function. So you had a team from NextEra that went down there, and essentially, there people were cutting copper from the cords. You have good management team that you put in place, and all of a sudden it's producing 25-30% more energy than before. There's something to be said, at the end of the day on the equity side that has the greater governance and management impact. And at the end of the day, instead of just literally just throwing money, fattening the pig, and if it blows up, it blows up. And if not, okay, maybe you make some money.
I'll take a different approach to your question. I think that a lot of deals are going to require more equity. So whether that's a refinancing of an existing loan that was, cut in 2021, here we are 2024, you're looking out at a refinancing wall that I think is relevant to commercial real estate, private equity, and a number of other asset classes. So I do think a lot of the managers in private credit are pretty good, but I think a lot of people have problem books when they were underwriting very aggressive assumptions in 2021, a lot of pro formas, a lot of add backs, a lot of adjustments. So everyone's really good at playing with the numerator and the denominator when trying to get a credit memo through, but I do think there are issues out there. But again, a lot of them are first lien loans. They're $1 on the balance sheet, and I think there's meaningful equity cushion below. So are those loans going to go to zero? Probably not. But, are the equity investors who did those deals probably going to have to, grapple with poor returns? Yeah. But I don't think there's a bunch of losses in private credit that are just sitting out there. I think maybe in commercial lending and commercial real estate, but not in private equity.
You might see slight differences in vintage years as well. I think it's certainly a valid concern. You look at 2021. I think you got a lot of things that were underwritten to just somewhat ridiculous valuations. You look at today. I think investors, including private credit investors, are much more disciplined in their approach in evaluating opportunities. Hence, the pace of deployment has slowed down significantly since 2021. And you look at the underlying fundamentals of a lot of private companies, much greater focus on profitable businesses instead of just growth at all costs and burning a lot of capital. There's a big difference there.
Any other questions, or are we getting shut off? One more.
Question for Christian or others. How do you get attention from U.S. investors or Asian investors for something like an investment in Guyana or some other like tertiary market, and how do you get comfortable with even if you eliminate the currency risk, tax, political risk, and all this other fun stuff?
I'm the wrong guy to answer that.
Okay. I'll go ahead and answer that.
Sorry.
It's not easy. It's not ezy. I mean, the returns are great, et cetera. You have a huge opportunity, but there's a lot of education. And partly goes to what I was saying before. When you particularly look at, all of our general partners are first-time investors in the region. And when you look at big institutionals and others, and let alone if you look at family offices, just mostly want to invest in the U.S. And if you look at institutionals, like they'll say Mexico and Brazil because the ticket sizes are big. Everything else, the ticket sizes are too small, et cetera, and it's not worth it. And then that risk also has kind of like spilled over into the smaller countries. I would argue, and actually we have a pretty good matrix that we've done with our what we call the LARA 12, that the risk level in our LARA 12 countries is less than Brazil and Mexico for some of the reasons we talked about and others. But it's an education process. It's really about, and we have, Rich here who's the head of investor relations, and he's going around and it's a challenge educating, let alone people where Guyana the hell is. First of all, you got to explain to them where the Guyana is. And then you explain to them, you realize is now the largest per capita producer of oil and gas in the world, right? It's a big deal. Like, I mean, it's a great story that's coming out. So, you know, it's what it is. But that's why we're the only ones in the space right now, and hopefully, you know, when we're very successful, then everybody will come in and want to be on the space as well.
Awesome. One more question. Last question.
All right, Congresswoman.
Thank you, thank you, thank you.
It's a big
Where
question.
is that guy that was in the slide? I don't know, because I don't see him on the panel there. Changed a little bit.
Better looking now.
Much better. You only get better. What is the U.S. government and U.S. Congress doing wrong that is not stimulating the economic environment and our economic partnerships with our democratic partners? And what should they be doing? Is there some harm that we're doing? And what can we do better? What can we stimulate more investment like this?
I mean, I think you just look at the regulatory environment today, all the red tape, the anti-merger lawsuits that the Department of Justice is launching against, it's pretty ridiculous. You look at other more localized policies. Well, this is another topic, a conversation about California. Like, we just have, it's unbelievable. But I think it really starts, from the top too, like the dynamic. It's just not very, very productive in stimulating the engines of the economy. And we're free markets. We've always been like that. I think the market can control itself in many ways.
I'm of the opinion, having just left California and lived there for 36 years, and I'm 38, so my data set is not great. But I will tell you, having invested across the U.S. for since 2007, so however many years that is, but I've never in my life seen such a meaningful divergence of excitement, interest, and capital flow as you've seen between red states and blue states today. I think it is very meaningful. You talk to owner entrepreneurs in blue states, they're constantly feeling like there's really just a flow against them. When you come here, it's different. And I have to applaud the local economy and all the folks that help, put policies in place, because it is very different. And I think the blue states are really starting to see the quality of life deteriorate, and there may be a reckoning, but I just don't know when that will be.
Let me take that one step out kind of regionally, because I know obviously Congresswoman has been very focused on foreign relations and the region. Look, the biggest challenge in Latin America and the Caribbean is that these countries are highly undercapitalized, and then that there is a capacity issue in regards to kind of packaging really good deals. When I was in the previous administration, when I was the president and senior advisor for Western Hemisphere, we created a program called America Crece, and it was part of the whole counter-China policy. And when you did that, what we quickly had to realize is the United States government cannot compete with the Chinese when it comes to sovereign lending, when it comes to sovereign-backed investments, et cetera. But what they can do is, what they can't compete is, because our biggest comparative advantage is our capital markets. We have the greatest capital markets in the world. We have the greatest private capital markets in the world and private investors in the world. So how can we facilitate for private investors to basically look at these deals and package them? And that's what we did. So we started creating these energy and infrastructure frameworks with countries in the region. We ended up doing 17 of them, so it was more than half of the region. And literally, we helped them with the tools of the U.S. government, including TD, et cetera, to package, understand the best deals, package them, and send them off to private investors. And it was extraordinarily successful. It was then a project that I took over to the Inter-American Development Bank, and in 1 year, we went from $17 billion in lending to $24 billion in lending and doubled the bank's net income in a year. Basically doing that. And that's now pretty much what we privatized as well, and that's what our fund is all about. So what can be done, et cetera? Find ways, instead of finding ways to write the check from the government, which at the end of the day creates distressed assets, creates long-term lending, that's, et cetera, and becomes huge disincentive and crowds out private investors, find ways to stimulate, crowd in private investments and create that opportunity for them to come in.
Thank you, guys.
Awesome. Great job, guys. Thank you all so much.